Today is Monday, August 3rd, and this is a post-market review for the stock market activities today. Buckle your seatbelts because we have a little bit of a different video today. We're going to take a different course. We will start per usual looking at the closings and the sector performance, the future performance, and the heat map. And then we will dip into the charts just to look where the indices closed and important points on the charts. But I will conclude by answering a theme that I've seen today in the market of shorts or bears giving up on the market, saying that, oh, you know what, the market's just going to keep going up and up every day. We're going to give up. We're going to join the long side. We're not just going to sit every day and watch the market keeps going up and up and up, and we're missing out. We know it's a bubble, but the bubble will continue to inflate and inflate forever. I will answer that question. I will give you a clearer picture psychologically why this development is very important to where we are in the market. But let's start by seeing how the indices closed. The indices closed in the green today. The Dow is up 236 points or 0.91%. The Nasdaq is the outperformer, up 157.5 points or 1.47%. The S&P 500 closed in the green, up 23.5 points or 0.72%. How about the sector's performance? The sector performance, of course, as expected, tech takes the lead again. Healthcare follows in the second place. And the laggards, of course, the trades that caught a bid in the last few weeks, utilities and real estate, aka the safety sectors. What about the action in the futures? Any development in the futures? We've seen crude oil rallying today, natural gas, of course, on a tear today. Coca continues to be on a tear. The breakout continues. It is up again today. Coffee taking a break today. Of course, been on a rally, a mini rally in the last few days, and now it's taking a little bit of a break. What about lumber? Lumber took a break a few days ago, and now it's resuming the rally and the march to the northern direction. Silver closing up. Copper, what about copper? Copper is up too. I'm an investor in copper. That is good for me. I like seeing copper in the green. Lean hogs, unfortunately, the pain continues. Another red day for lean hogs. Now, let's take a look at the action in the heat map. Right away, you can see that the leaders are the big boxes of Microsoft and Apple closing in the green significantly. And of course, Amazon, surprisingly, is the laggard. So we're not seeing everything going up together. Today was a bit of a different kind of action that we haven't seen before. We are seeing winners and losers in each sector. It is no longer momentum versus value or stay at home versus reopening stocks. It is very different. We're going to go into that in details. Look at Microsoft. Microsoft closed in the green significantly. Apple too, but Amazon, not so much. Amazon, I don't know, maybe Jeff Bezos' ex-wife is dumping shares. Of course, she has big charitable ambitions. And good for her. She wants to dump stocks. Who cares? But the story, of course, is Microsoft. Microsoft announcing over the weekend, or specifically on Friday, that they are looking to acquire TikTok. This is a case of jumping the gun too fast. The moment they announced that they were acquiring TikTok, what do you know? The next Saturday, the next day, President Trump, of course, issues an announcement that they were ban TikTok from operating in the United States. Here is a case of opening your mouth a little early, and I think that Nadella and Microsoft's executives lost their mind with this acquisition. You should have waited till after the announcement of the ban so you can acquire the company TikTok for a lot lower price. Their valuation would have dropped significantly. They're banned in India, banned in the United States, soon to be banned in Australia. In Europe, this is a company that's being destroyed in terms of valuation. Why not wait a week before announcing, rescuing the company and offering to acquire them? It would have cost you a couple of $100 million. But now, of course, Microsoft will have to shell billions of dollars because they've announced their interest a little too soon. And now there are other companies also looking to bid for TikTok before it gets banned permanently in the United States. The whole social media TikTok saga is getting crazy. TikTok is now accusing Facebook of smears and plagiarism. And of course, this is really interesting. I don't know why Microsoft is interested in buying TikTok. To buy it, they will have to shell billions of dollars now. Why do it to distract from your core business when your Azure cloud growth is slowing? Shouldn't you be investing in increasing your market share in the Azure business? Concentrating more in the Xbox business. TikTok does not fit Microsoft product suite at all. I don't know what they're doing. They think that they're getting a good deal, but they're not. Investors today did the knee-jerk reaction by celebrating the acquisition of TikTok. Of course, it didn't take place yet, or hasn't taken place yet. But when they see the price tag that Microsoft is about to pay, that will send the shares to the southern direction. Because why shell so much money right now on a company that was supposed to disappear to begin with? This kind of behavior reminds me of the dot-com bubble, when companies like Yahoo saw their valuation skyrocket and they acquired companies, dot-com companies, smaller ones, left and right, overpaying for these businesses. And before you know it, when the crash happened, Yahoo crashed and could not survive, and these businesses disappeared forever. Now, what about Apple? Apple, of course, building up on the stock split mania, but we are seeing a little bit of a dissipation of the excitement here. The stock closed well below the highs of the day, as more investors do their research and realize that the stock split means absolutely nothing. The gold rush into the stock is absolutely unjustified. And as investors start to figure out how the stock split really work, they will start exiting these shares, and you'll see that pop, that rally, that inflation that happened recently giving up a bit. Of course, the stock split 4-1 does not mean, I repeat, does not mean if you buy now, you will get 3 more shares for free. I don't know where you got that idea. I don't know how people got to that conclusion, but it is not true. You will not get 3 more shares for free. Now, let's look at the heat map in details and see the disparity between even names in the same sector here. Remember the garbage stocks, the casinos, the airlines, the cruises, the hotels? Well, their performance today is different. They're not trading all together in one box. For example, the cruise industry got hit very hard today on the heels of news that the first cruise that sailed had coronavirus cases in it. Cruises at this point is a floating death buffet. And this piece of news confirms the weakness in the cruise industry. The pain will continue and prolong for longer than you ever expected. However, and maybe this is a little bit of a disconnection, or maybe we have hit a bottom here, at least that's the assumption from investors. What about casinos? Casinos rallied modestly, not very much, but overperformed the cruises, of course, even though we've seen news from Macau that revenues for last month declined by 94.5%, which is a huge number. Yet investors are kind of brushing that news away for now, of course. What about apparel retail? Apparel retail is experiencing a lot of pain, and the pain continues. You see the underperformance here in the consumer cyclical box. We have another one that bites the dust here, bankruptcies for men's warehouses or men's warehouse. They will not be able to survive in this environment. People are staying home, working from home in their pajamas. They don't need any suits. Our country's oldest retailer, Lord & Taylor, rest in peace, files for bankruptcy, gone, goodbye. Now, let's dip into the charts. Taking a look at the SPY, the S&P 500 chart, you can see that we are now trading well above the resistance line. So what is the next destination here? The next destination is the gap that I'm pointing at right now, from which we broke during the coronavirus correction. The bulls and traders, of course, are setting their targets that the rally will hit the gap. The gap is the destination to ride to. Heed this warning, however. Right now, shorts are giving up, bears are giving up. The people waiting in the sidelines, the traders waiting in the sidelines, are now feeling that the water is warm to hop in. They're hopping in. Shorts are switching their bets from short to long. And what do you know? Before you get to that gap, you will get very, very close, and then they will pull the rug and smash it in your head. Where did we see that before? During the February correction. The market keeps going up and up and up every day. The moment bears gave up, switched to the long side, that was the moment where they crashed the market on their heads. We're going to talk about that in details in a little bit. What about the Qs? The Qs break above the bear channel, the lower trending channel. That is very positive behavior. We need to see it trading above it tomorrow, holding the break. We don't want to see it dipping below again. And of course, looking just secularly at the SPY and the Q charts, you can come to the conclusion that this is a rally, a bull market that will continue to gain 1% or 2% every day. But keep your eyes on the indicators. What am I talking about? Take a look at the VIX. August is known to be the VIX month, the volatility month. The VIX refuses to break down. With all the rallies that we have seen in the market, the VIX continues to hold steady to that blue line that it drew on the chart. Refuses to break, holding to something, gathering energy for the break. So keep your eyes on the VIX. The VIX closed in the red today, but not by much, even though we had a huge rally in the stock market proportionally. Now, I want to do something else. Let's talk about some options trades that I did today. I did a lot of them, about 5 of them. Of course, the earnings calendar this week. The first trade I made on Disney, it's a bullish trade for the 120 calendar spread, of course. Buying the 120 for August 14th and selling the August 7th this week, 120 call, all in all for 45 cents an option or $45 a contract. All what Disney has to do, of course, is to beat on the number of Disney Plus subscribers. That will excite the market and will, of course, forego all the woes from the decline in revenue in parks and studios and even networks. Another bullish trade I opened in Nikola. Nikola, of course, I was shorting at the top in June and I closed my short a while ago, but there are a lot of shorts that did not close. The greedy shorts, of course, they wait till the last moment to close. And today, of course, as expected, they're scrambling to close before the earnings, sending the shares up significantly. The short squeeze happened before earnings, not after, as I was expecting from this trade. Here is the trade for the 35 call, selling the August 7th while buying the August 14th, expiring next week, of course, all in all for 50 cents or $50 a contract. As of the closing today, of course, this 35 call, the shorter leg and the longer one, because they're all for the same price, 35. The strike price. It is in the money. If Nikola comes Friday closing above this number, 35, you have to close the shorter leg, you have to buy it back, and then let the other one, the expiring next week, ride on. Of course, this is a name that I shorted, as I told you, and I covered my short back in July 6th because the charts, the technicals here, reached the lower end of the breakout candle. And that for me was the sign that I should cover my shorts. It was timed perfectly. The stock rallied a little bit after. Yes, it dropped later, missed out a little bit, but don't be a greedy pig. Don't wait till the last moment to cover your shorts. Don't be lazy. Otherwise, I'm going to make trades like this and make money off your laziness. Another name, of course, I added to the puts in the XBI, the biotech sector. The biotech sector had a very big day to the upside, up 4%, of course, because of the rally in Novavax. Novavax is a very speculative name. They're pushing it to the upside. A lot of shorts, of course, are scared right now. They started covering right before the earnings. We're not sure if they're going to report earnings this week or not. There are no information. There is expectations that they will report the earnings this week, but there is no final word from Novavax. With that being said, there's trial results that are about to be released this week for Novavax. Whether the trial bombs, whether we see sell the news phenomena, whatever it is, if you want to short Novavax, please do not use put options. I put that in a tweet right in front of you because the put options for Novavax are extremely expensive. It doesn't make any sense to buy them when you can short the XBI instead for a lot cheaper, for cents on the dollar, and you will get the same impact. If Novavax crashes for whatever reason, so will the XBI. You will reap the same fruits and the same gains for a lot lesser entry price. It is the best bang for your buck to short Novavax. Of course, I added puts in this name or in this ETF, the XBI, last week. I bought some puts a little bit for the August 21st, expiring August 21st. And I added to those today. They were really, really cheap. I added more because, of course, the XBI rallied. Another bullish trade, I made options trade on Uber. Uber reporting this week, I made the calendar spread, the bullish calendar spread for the 33 strike price, selling this week's 33 strike and buying the strike for the 21st of August, the week of the 21st of August, expiring that week. All in all, the entry price is 45 cents or $45 a contract. Here is the last option trade of the day on Penn National. This is a bearish one. Calendar put as well on the magic number again of $33. Selling the 7th of August, the 33 strike, and buying the 21st of August, the strike of 33 again. All in all, the cost is 91 cents or $91 a contract. As you can see, the strategy with the spread gives you a very low entry price with the current VIX environment. The VIX is stable. That means option prices are very cheap. Take advantage, position yourself because they're not going to stay cheap forever. Now, let's discuss this important point of shorts and bears giving up, saying that this bubble will continue forever. We need to give up. We need to join the rally. We're missing out. We're losing our money. Basically, waving the white flag. Let's see how long is this current mania that we're in lasted so far. From the bottom, if you scroll and you mark a date, we are now at day 133 of the mania of the rally that we've seen from the bottom, the aka coronavirus rally, or Fed liquidity rally, or stimulus rally, or vaccine rally, whatever name you want to put on this era of the rally. Now, let's go back in history all the way to the dot-com bubble. How long did the dot-com bubble last? The legendary dot-com bubble. Some historians will say it started in 1998 and lasted all the way to 2000. I measure, of course, the mania part of the dot-com bubble so we can have comparables with what we have today. The mania part of the dot-com bubble started in October 1999. And from that date all the way to the top, to the crash, it was 161 days. So we are about 28 days to reach that milestone in our current rally. We are 133 days in our current mania. The dot-com mania lasted for 161 days before it popped. Now, of course, that doesn't mean we're going to crash when we reach 161 days in our rally. It doesn't work that way. We're not in the psychic business or in the wizardy business. But this is a parameter for you to understand that rallies can last for a long time. Manias can last for a long time. You will never, ever be able to time when the bubble will pop. Not me, not you, not him, not her. Nobody will ever be able to time the stock market. Therefore, when you make your bets, you want to avoid time-sensitive bets and time-sensitive investments. Meaning, do not bet by using options, specifically options expiring in a shorter date. That is suicide. That is timing the market. That is one of the psychological mistakes in investing. It is called playing God. Playing God never works. If you buy a put option on the market saying it will crash, we've seen this in last month. They said that July 29th is the date when the market will collapse, like a prophecy. It doesn't work that way. If you buy the puts for this week saying that the market should crash today, you're going to lose your money again. Don't play God. Look at what I'm doing. I have position in the VIX, buying the VIX, not options, buying the actual VIX, buying the actual short NASDAQ, the short triple Q, not the options, because I can't time the market. So I want time to be on my side. We all know this is a bubble. We all know this is a mania. We all know how it's going to end. But timing it is a suicide kind of business, financial suicide. You don't want to time it. So you position yourself and you give yourself time. Am I underwater in my VIX position? Yes, I am. Am I underwater in my short triple Q position? Yes, I am. But you gotta have ideology and standing in the market. If you follow whatever the tide goes, the hot trades, you will bury yourself alive. You will switch right now and chase the hot trade. You'll buy Microsoft, you'll buy Apple, In a few days, they'll pull the cord, they'll pull the rug, crash it in your head, and you're gonna cry because chasing whatever hot trade is, short or long, is not good investment strategy. Have some standing. What is your standing? What is your ideology? What are you seeing in the market now? Have you looked at the indicators? Have you looked at the technicals? Have you looked at the economic conditions? Have you looked at the psychology of the market? Have you looked at the underperformance and overperformance of the market? Have you formulated your conclusion on the market or not? And if you did, and if it is bearish, like mine, then don't do time-sensitive bets. Give yourself the time for your bets to formulate and to mature successfully. Now, I know what you're saying. You're saying that the dot-com bubble is different than the bubble we have today because today we have the Fed and the Fed's liquidity. The Fed will continue to flood the market with money. This is why it is unstoppable. Please understand that the Fed does not buy the stock market. The Fed does not buy actual stocks. The Fed provides companies, public companies with liquidity. They buy commercial papers, they buy bonds, they buy CLOs, they buy all kind of collaterals for loans. They give loans, they expect to collect these loans back. They have an interest to be paid back on these loans. That will inflate the valuations of companies, but it also inflates their debt positioning. So it's a double-edged sword for the financial valuation of a company. Now you could say the interest rates are lower. That is true. The interest rates are lower, almost to zero, but the valuation have surpassed factoring the lower interest rates. It's already factored in. We've surpassed that point in the rally. The valuation is way ahead the interest rate factoring should be. Now the Fed did something new this time around and it's buying actual ETFs for corporate bonds. But they're not buying it significantly. Look at the Fed's balance sheet. They did some buying, but they did not do significant buying to move these ETFs. What happened here is investors rushed to buy first. The psychological rationing here is let's buy first because the Fed will buy it back from us at a higher price. So they pushed all the numbers, all the stocks, all the ETFs, all the bonds way above where they're supposed to be. And the Fed now is looking around saying, hey, are we that stupid to buy right now? Or should we wait for a correction to buy? Because what is the point of buying at all times high if the point is to stabilize and save the financial markets? They've already saved by the factor of psychology alone. Debt does not substitute for revenue. You can have the highest valuation in the world. Comes next quarter, the consumer is not recovered yet, unemployment is not back where it's supposed to be yet, and you see slowing down in revenue or negative growth, and now the expectations are so high, that is the recipe for the crash and for the disappointment and for the underperformance to come. Remember, they're not going to make it easy for you. They're not going to announce that the bubble is going to pop tomorrow. Please sell your shares. Please buy protection. Please buy some put options on your shares. That's not going to happen. They're not going to announce it to you, knock at your door, and tell you the crash will happen at this specific date. What will happen is you're going to feel very comfortable with the market rally going up 1% or 2% every day. You're going to hop in and you're going to score for a couple of days. You will feel vindicated of your decision to switch back to the long side. And what do you know? You wake up one day, overnight, something happened about China or whatever it is, and the futures is down over 800 points and the sell-off continues from that point. It marks a top. You will not have time to exit the market. They will do it overnight in the futures and surprise everybody. So please have standing. If you're going to buy the market, if you're going to go long, at least have a standing, have some ideology behind your move, have some reasoning and rationale behind your decision. Don't just do it to chase how the market is going day to day. That is a recipe for disaster. We have stretch valuations. We have a job report that's about to come that will clear the picture of where we are in the recovery, the V-shaped recovery, so-called V-shaped recovery. The numbers on the ground will determine the destination here. You can inflate it all you want with Fed liquidity, with stimulus. If there is no recovery in consumer spending and consumer purchasing power continues to dwindle, nothing will be capable of saving the market. If you found the information presented in this video helpful, please subscribe, press the like button,
the notification button, and follow me on social media.